Hello everyone, thank you so much for watching my YouTube channel. Let's talk about Tesla, guys. You see here, 15 minutes later, Tesla CFO who oversee consistent profit and investment credit rating was even master of the coin is leaving after 13 years. Yeah, somebody chief of financial office, something like that, is leaving Tesla. Tesla is just trading down, stock is falling down, and let's go down here before we hear some news. After down here, Tesla stock is sliding today. What's going on? So guys, Tesla is going down, and my personally prediction I did, I'm seeing Tesla will come towards 220 to reach oversold. We saw Apple coming today to oversold to 175, and we still need to confirm that oversold. Uh, yes, guys. So let's go and hear this news. It's loading.
Is it recession avoided or simply just delayed? Good morning, Jonathan. You may recall our conversation much earlier this year when I had said that the last time so many influential people said something was going to be as great as the bond market was expected to be with the Firefest. And I think that's exactly what we've seen. And our view had been earlier this year that the economy will prove to be stronger than what was being priced in, that Fed cuts were not going to materialize to the aggressive extent that was being priced in. And that's exactly what we've seen so far this year. So, of course, now the calls for recession this year have been pushed out, as they have been really for much of the year, by a few months. But I think what's much more important than the sort of inflationista versus recessionista battle of this year is really if we pick up our eyes and look a little bit farther out to the horizon and see that this fiscal spending that's certainly contributing to this move in yields, along with a number of other factors for sure, but that this fiscal spending is not likely to stop, that the demands in the public purse are going to continue long term, and they're going to continue stoking long run higher inflation. That doesn't mean we're going to go into any kind of an inflation spiral, but it does mean there will be more volatility to interest rates, to the bond markets, and that the last decade is nothing like what the next decade is going to be like for fixed income investors. From your standpoint, where is that risk? Is it in credit or is it in sovereigns at the moment? It is really both, because there is no impetus, again, for the Fed to really do anything here. You have a strong economy, you have strong housing, you have low labor, unemployment, essentially. And so there's really nothing to point to say that, look, this is recession right here, or this is weakness right here, or this is why the Fed needs to cut right now. And without Fed cuts, we're going to see this market try to stand on its own, which means it will have to reprice to the longer term expectations for higher growth, and some of these other issues around fiscal spending, as well as the fact that the other two huge anchors, the ECB and the BOJ, are also normalizing their policy, pushing rates higher. So I think interest rates will continue to be a risk for sure, and we're likely not done here. This bear steepener may have some more room to run, but the credit cycle is also underway for sure, right? We saw the bankruptcy of Yellow this morning, and that's just one of a string of bankruptcies that has continued to be kind of a steady drumbeat against the backdrop of this stronger economy. The lower rated credit companies are certainly beginning to struggle. We've seen the default rate triple, albeit from incredibly low levels in the beginning of this year, but the credit cycle is underway, and we think that the credit repricing, the corporate credit repricing, will happen, frankly, irrespective of whether you see a broader recession or not, simply because these lower rated borrowers are going to really struggle to find cheap financing in this higher rate world. And I think that will open up very attractive opportunities for credit investors. We've seen even since the beginning of this year, the very weakest part of the high yield market, the triple C's, have jumped, very significantly in their spreads compared to some of the better quality names in that part of the market. So you do see kind of the weakest leading in terms of that spread widening. We haven't seen that spread widening anywhere else in the market yet, but we do believe it's coming. For investors who have liquidity, there will be a really great opportunity out there in the next 6 to 12 months.
CPI on Thursday, PPI on Friday. Oksana Jimpienko of Bianco Research has said he thinks inflation is bottoming out for the year. He doesn't think from here that you're going to see a continued deceleration. What you'll see, to what Keith just said, is inflation picking up again into year end. Are you sensing the same thing?
I definitely think that that's a very distinct risk, and we are seeing, of course, energy prices perk back up, where there's a lot of questions around other commodity prices given the war in Ukraine and the wheat prices. But there's also kind of, John, a perfect storm around, to the extent that we are talking about interest rate levels, right? And that's why we're talking about inflation. It's the cost of capital, which of course impacts everything. There is kind of that perfect storm in the works right now, and inflation is just one of the moving parts. You've had this higher than expected amount of treasuries and auctions.